Hey everybody, what's up? It is Thursday, June 25th? Yeah. Some funny stuff today, I gotta tell you, and I'm gonna go over it. First of all, we had a rally and the market bounced back today, and it came off of a couple of headlines, I guess you can say. Because it wasn't doing much for most of the day. It was up, it was down, it was up, it was down, it was down early, then it made back some of those losses. Before I get into those headlines, let me just mention that the weekly initial unemployment claims, I'm trying to remember this off to the top of my head, it was like 1.48 million or something like that. Anyway, it was down 60,000 from the previous week, and the prior week, that means last week, it was revised to down only 26,000. Now remember, I've been talking about this. Last week I spoke about it, how my tax flow numbers, those employment and withholding taxes, they're kind of predicting that the job market, the labor market is not bouncing back very strong. So if you take the average of these 2 weeks, the 26,000 decline and the 60,000 decline, that's an average weekly decline of 43,000. And I mentioned that the prior 4 weeks, the average weekly decline was 322,000. So the amount of people, the drop in the number of weekly unemployment claims, new claims being filed, that drop has really shrunk. I mean, this thing is not coming down so fast anymore. It came down fast from the peak, and now it's kind of leveling off around 1.5 million. Anyway, just wanted to mention that. Now, there were 2 headlines. The first one was regulators are, I think, either suspending or cutting back the Volcker Rule. The Volcker Rule was imposed after the great financial crash. It limited the banks' ability to speculate in riskier things. All right? So they are cutting back on the Volcker Rule. Now, I just find this kind of funny, and I'll tell you why. Because, first of all, it's again this concept of, hey, we're going to restore the economy through a debt-based approach, like giving more loans, as opposed to Congress ought to pass another stimulus bill with more money, with a payroll tax cut, with, infrastructure, whatever. But no, it's again this notion that, yeah, we're going to get out of this by incentivizing more debt. I don't think that's a great way to do it, frankly. But you can see it. This is, the same thing with these Fed loans, which, by the way, are going begging. Like, there's only been 70. Remember the $500 billion that Congress gave to the Treasury, that Congress gave to the Fed, so that the Fed could leverage that up to $4 trillion. Well, guess what? $4 trillion. Only $75 billion in loans have been, doled out so far. So they're going begging. Nobody's coming for those loans, which is probably, I don't know, maybe a good thing, maybe an indication that people just don't want to take on the debt. So here's the thing. So they said they're going to cut back on the Volcker Rule. Now, first of all, in the last 6 weeks, there's this thing called bank residual, which is what I look at every single week. That's bank assets, and I've mentioned it here on videos. It's assets minus liabilities. It's literally the net worth, the wealth of banks. It's their capital. That has dropped by 70 billion. So 70 billion in capital loss, that's equal to 700 billion in lending capacity. So that lending capacity has functionally shrunk by that amount because of that decline in the residual. So I mean, banks, this relaxation of the Volcker Rule, I don't think it's going to incentivize banks to jump into highly risky investments right now. So that, of course, what happened on that announcement, the market ran up. The zombies jumped in, they started buying. Again, anything having to do with the Fed or banks, they jump right in. Never mind the fact that banks in the last 7 or 8 weeks, lost something like 175 billion in assets. Their asset base shrunk by about 175 billion. As I mentioned, residual down by 70 billion. So the trend is not good for the banks, even though they bought the bank stocks today. The second thing was the stress test. Now, let's face it. All the banks know they're going to have to go through these stress tests, twice a year or something like that. So, they prepare for it. Very few banks fail the stress test. They know how they have to comply. So, that was another announcement that shot the market up. Let me give you a little bit of background, all right? Just remember back on June 14th, when it was announced that the Fed was going to start buying corporate bonds, and we had this big rally on that day, and everybody was all over that stupid blog Zero Hedge, and people talking about, they're juicing up the markets. The Fed is juicing up the markets. They're juicing up the markets, right? All these knuckleheads who constantly think it's the Fed, and again, the Fed can lend, it cannot spend. Well, guess what? The S&P is basically exactly where it was when the Fed made that announcement about buying corporate bonds. All right? So, you got a week or two of this rally, this knee-jerk reflexive rally by the zombies and these knuckleheads who constantly, they're juicing up the market. They're juicing up the market. We're right back here again. The Fed can do nothing. It sets interest rates. That is a very indirect effect on economic activity, and actually the true effect is opposite of what most people think. When the Fed cuts rate, and it's very obvious now, we are up year over year, almost 5 trillion in public debt issuance by the Treasury, and interest payments to the economy up only 9 billion with a 5 trillion. That is unprecedented amount of increase year over year. But last year at this time, interest on Treasury securities paid by the government up almost 30 billion. So you've had this massive increase in issuance. So you would think with that amount of new Treasury securities in the economy, so much more income would be earned, but the rate cuts, the cuts to zero, have reduced that to virtually nothing. So rate cuts take income away from the economy, rate hikes add income. Of course, it's not distributed equally. I don't know too many poor people who own treasuries. When they raise when they raise interest rates, that's basically a subsidy to rich people. That is welfare to rich people, let's face it. So yeah, there we go. So we had this bounce in the market. Meanwhile, you got a questionable job recovery going on. We're going to see the numbers next week on Friday. We're going to see the June numbers for payrolls. But I don't see any turnaround whatsoever in the tax flows. They're still negative year over year. It's a downtrend. Coronavirus now, I'm sure you've been reading that they're surging all over the place again. We're having new spikes. As a matter of fact, yesterday the United States hit a new all-time one-day record in new cases. So that's going on. So yeah, we had the news, a relaxation of the Volcker rule. The zombies jumped in. Wow, this is going to be fantastic. Just like they did 2 weeks ago with the corporate bond. Wow, this is going to be fantastic. We're exactly back to where we are. All right, everybody, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. Remember, I'm the only one who has an applied approach to MMT. And also listen to my podcast. If you go to my website, pitbulleconomics.com, and if you click on the podcast link, this new one that I just did, episode number 4, I think you'll like it. It's a good one. All right, everyone, stay safe, stay healthy. See you tomorrow. Bye.